Have you ever wondered if you are playing it safe with your investments? Maybe you have heard that diversification is key, but you are not sure how to get started or why it matters. Well, in today's video, I am going to show you why diversification could be the difference between a secure financial future and a risky downfall. If you want to learn how to protect your investment and grow your wealth, stay tuned till the end. This might just change the way you look at investing forever. What is diversification? What is definition of diversification? Importance and key principle of not putting all eggs in one basket. As we know that investment in stock market is very risky, then we need to understand, we need to learn to manage the risk, because we can't skip or we can't switch off the risk. We don't have the button, just put off the switch and there will not be any risk. So in a stock market there is risk. So how can we manage the risk? This is the main thing. Diversification. If you diversify your assets, if you diversify your portfolio in different asset class, then you can manage your risk. So in diversification, we need to invest in different asset class, and this is the importance of diversification. If you diversify your capital, then you can protect your capital, and rather than putting all eggs in one basket, it is not a good approach. If you are putting your whole capital in a stock market, then it can be big risk for you. So you should put your investment in different asset class. Why diversify? Reduce risk of large losses and protects portfolio from volatility, as I told you earlier, and balance return over time. Balance returns means if you are putting your capital in five assets class, if one is not growing, and if one asset is in consolidation phase or downtrend, but your entire capital will not stuck in one place, because remaining assets may give you good return in during that phase. Now move to third point. Types of diversification. It is very important. First is asset class diversification. You should put your investment in stocks, bonds, real estate, and gold. In earlier video, I have given you the formula, that is 100 minus age formula. 100 minus age formula means you just put your age, 100 minus age, and you will get, like, if your age is 40 and 100 minus age it equal to 60, then you can invest 60% of your capital in risky assets, and rest 40% you should invest in bonds, real estate, gold. This is asset class diversification. Second is sector diversification. Yeah, here you are putting 60% of your capital in stocks, but you should not put your whole capital in one sector. Sometimes we see that some sector is in downtrend and some other sector is in uptrend. So if we put all our capital in one sector, it means if that sector will not grow for 2 years or 3 years, it means our money will stuck in a same place. So we should put our investment, our capital in different sectors, at least five sectors. And third is geographical diversification. domestic and international investment. We should uh, you should we should do the study in this way that the revenue of company is coming from where. If revenue of all company, like if I'm buying the shares of 15 companies, okay, and all 15 companies revenue are coming from one particular state, one particular country. It means if some kind of problem will arise in between India and that country, or if something will happen in that country, it means our whole capital will be in a big risk. So we diversify in terms of geographic. So we should see the revenue source. It should not be domestic. It means all the company revenue should not come from India only. So there must be diversification. If you are putting your capital in 15 companies, so you can diversify in two, three, like some company revenue from India, some from other country, in this way. Risk diversification, mix of high risk and low risk investment. Meaning of this, you should invest in whole three market cap, like in large cap, in mid cap, and small cap. By this, according to this way, you can manage your risk. Common mistakes to avoid. First mistakes, what we do, over diversifying. Over diversification is also not good. Not focusing on quality investment. We only sometimes we only focus on the diversification, but we forget to give the focus on the quality investment. And third is diversifying without understanding the market. For example, if you don't have any idea about cryptocurrency, like I don't know anything about cryptocurrency, so I don't put our money in cryptocurrency, and I do not create any video for cryptocurrency, not on in a positive side, not in a negative side, because I don't know and I don't want to understand actually, because it is different things. So I do not want to even try. So you should understand the market before putting your money in that place. Conclusion. Recap of importance of diversification. With diversification, we can manage our risk. And now, call to action. If actually this video is for diversification, now that you know the power of diversification, it's time to put these strategies into action. Remember, the key to a secure financial future lies in spreading your risk, not putting everything in one basket. If you found this video helpful, don't forget to like, subscribe, and comment below with your thoughts or any questions you may have about diversifying your investment. Let's build a better financial future together. See you in the next video. Thank you so much.